right, well, welcome. Appreciate you guys joining. We discussed beforehand we're not going to do intros just because it wastes time. You guys all know who we are, or you can figure it out. We'd rather just jump right into it, seeing as we only have 30 minutes. So we're here to talk about, obviously, secondary market liquidity, how to improve that, how to create more folks in the tent, as they say, and generate a lot more ability for folks to trade it and own it, whether it's bonds, equities, you name it, but whatever we end up building over the next few years, how do we get more folks in the market? So let's just jump right in. Philip and I are actually talking about this right before, and I think it's a great starting point, which is the rebuilding of trust in the market, right? So we've obviously all had a fairly difficult year and a half. We can go through the litany of issues in the market. Part of, I think, the benefit of tokenization is that it is a way to kind of rebuild trust and create a more trusted way for folks to own digital assets. So my first kind of question to you guys, and we have a little bit of TradFi and digital native up here between Chris and I on the TradFi side and Philip and Lucas on the more digital side. Let's start down at the end. What do you feel like will generate the most trust in the market over the next 6 to 12 months? And how are you guys thinking about that at Centrifuge? Lucas?
Well, I mean, our issue with creating trust in the market was always to kind of, well, we have two issues with trust in the market or trust in what we're building. There's the crypto people we have to convince that real world assets can in fact be used on chain and have value on chain. And then on the other side, there's the TradFi people that we have to get to trust that the technology actually works.
Yep.
So maybe that is like, for us, something to do. I think the other thing is just, I mean, the bull market made people expect 10, 20% risk-free yield. A lot of this was VC subsidized, or in many unfortunate ways, it was like retail subsidized, right? People buying token subsidies, trading token subsidies. That didn't go very far, but just distorted the market quite heavily. I would say like now there's a lot less activity today. Unfortunately, there's many fewer people coming in because it was a good way to attract capital, but it wasn't really sticky capital. So I do think like it's just going to shift focus a bit to more sustainable use cases.
Okay.
Yeah, Philip? We think about trust from the perspective of regulatory compliance,
yep,
right? Specifically providing the access rails around, for facilitating a compliant value chain on chain to purchase certain assets. That being in place, we think is going to be a huge catalyst for trust for institutions and then the broader industry.
And when you guys think about product, right, and your product roadmap, where does compliance and building trust fit? Is it top of mind? Is it kind of through the process?
For us, this is the product.
Right. Chris, from the VC side, and obviously you guys, Flow have operated in the regulated space for years. How are you guys thinking about investing in the space differently after the last year and a half? And do you think about the counterparties that you're investing in differently as far as trust and building better trust with them and then building it with the market?
Yeah, I think we think about trust the same way in the crypto space that we do in the traditional space. I think a beauty of a transparent distributed ledger is that there are more and more ways to show trust to participants in the market. And so like when dealing with centralized exchanges, having some sort of like proof of reserve, proof of custody, whatever they're calling it, there are ways to implement blockchain technology such that we, as like a traditional participant, can be more and more comfortable with what's going on, with what's being built, that our assets are where the more centralized players say that they are. Or on the DeFi side, having a UX, I think that is friendlier and making more apparent that things are indeed operating as intended.
Right.
How much more important is the transparency aspect for you, actually, compared to sort of like the more regulatory compliance aspect as an institution?
I think regulatory compliance is our first and foremost, like that's our biggest priority. We are a public company listed in Amsterdam. but we work very closely with regulators and are talking to them every day. And so for us, that's kind of always what will come first. But trust, I think, is a really great way for us to proposition to regulators when we're speaking to them, like, this technology actually does have some incremental benefits in the space. And there really is value here that we see disrupting traditional financial rails.
So just along those same lines, traditional versus, crypto, digital. I think there's there historically has been a general kind of us versus them mentality, right? And so my question, and I have a view on this, but I'll let you guys start, is what do you see that exists within traditional that you think the digital space kind of doesn't appreciate, and are you guys looking to bring in to your products? And what is one of the key things that you're trying to differentiate yourself from traditional with? Maybe we'll start in the middle this time. Phil?
Well, I think I'm probably going to repeat some of the stuff that I said before. It is sort of like really engaging with regulators, finding a way that sort of these completely on-chain native financial products can live in compliance with existing regulations. That's not to say that some of these regulations may not make sense and may evolve over the future. I hope they will. But I think there is a path for sort of the more DeFi or crypto native side of things to actually coexist in a way that fulfills regulatory compliance and then provides or really facilitates that trust and provides more secure on-ramp and ultimately help grow the industry.
Right. Lucas, any thoughts when you guys think about product? What do you look at on the traditional side that you borrow a little bit more from than maybe you'd like to admit? And on the digital side, what do you think you're emphasizing that really separates it from traditional?
I think we're not afraid to admit that we borrow a lot from the traditional side.
Okay. All right.
What I would say is, like, I've heard this a few times today, and it's true. Like, we're not fundamentally reinventing finance, and we have to be careful that we don't think we are, because otherwise we're just gonna have to learn all of these mistakes again. And I think you definitely have to think differently. I remember numerous conversations where we talked about instant settlement and things like arguments, debates that I had with people about interest rate models, where like someone from the credit world comes and says, "Oh, like we have 330 days of banking days. We have like daily, maybe monthly interest. It's like a bank year. Like, I don't think it makes sense to pay interest by the second, right?" And they're just like, "No, actually, it absolutely does. Like, why would you not, right? Like, if you can settle instantly, if you can trade instantly, like, you should also be accounting for interest instantly." And that is actually like, so there's things like that where obviously, yes, it's very different, but there are many other things that, like, I think the crypto native world has too little of an idea about, and where actually learning from finance is helpful. I think this is in market structure where, like, honestly, like the first DeFi protocols were built by engineers, and we've had many spectacular failures, but it's almost like somewhat surprising that some of those things haven't broken earlier. And we've luckily been able to like do a lot of those learnings today, where it's where like not a lot of money is at stake. But ultimately, like we do need to kind of make sure we're bringing that knowledge in, and that's like where we try to open up the most dialogue.
Yeah, that makes sense. Chris, from your side, from more of the traditional side and obviously the investing side, when you guys look at portfolio companies, are there aspects that you want to see from the traditional side, whether it's management team, whether it's a culture? Are there pieces that you want to make sure are there before you guys take that leap? And then kind of similar on the digital side, are there pieces that you want to make sure don't get lost because the traditional culture's there, and like the balance between the two, I guess?
Yeah, it's a good question. I think
that's why I asked it. So.
Yeah, thank you. Yeah, I think at least when we're talking to founders and potential investments, something that's like really important to us is generally that they're like at least very in touch with what's going on the traditional side. I think it's often helpful to have someone with, if it's a DeFi company, to have someone with TradFi experience, because I think like Lucas mentioned, there is a lot of like rehypothecation of traditional practices going on in the DeFi space, and so it's really helpful to have that expertise. And along with that, I think comes expertise on the regulatory side of the market. And as a public firm, like we need portfolio companies to also have regulation as a top priority.
Makes sense. Yeah. So, all right, let's get out of the TradFi space and talk about more fun stuff that we're all here for. So when you guys think about kind of that catalyst, that tipping point for larger, or let's just say mass adoption of tokenization and RWA, what is it that you guys, and you know, we can debate this all day and everyone's going to have an opinion on it, but you guys are up here and you're smarter than the rest of us, so we're going to ask you your opinion. What is that tipping point? Is it the large traditional guys coming in? Is it a mass dislocation in the traditional markets that creates a need and a drive? I think one of the earlier panels kind of alluded to it. Is it an unwind in one of the traditional markets that makes it obvious that tokenization is the right route, not the past? What in your minds are you kind of hoping for or waiting for to see that tipping point? Chris, we'll start down here.
Yeah, I think these guys will have probably a more like creative answer than I do, but I don't think what I don't think is that the tipping point is a tokenization of something that exists in traditional markets today. I think Flow Traders is an ETP market making firm kind of at its core, and the evolution of ETFs from like $0 in management in the mid 1990s to like 10 trillion today is kind of like the last large scale 0-to-1 shift, and that occurred because every participant in that equation was benefiting in some way, shape, or form. Retail had access to like a novel suite of financial products or like a basket of goods that was otherwise too expensive to participate in. Issuers obviously were earning fees, and market makers are able to facilitate the liquidity that makes those markets necessary. And so when I think about how tokenization comes into play, I'm not sure necessarily what the product is, but it needs to be something novel and something that inherently benefits more from being on chain than it would from being in a more like centralized traditional system.
Yeah, interesting.
Yeah, I would probably mostly agree. I think ultimately it's a function of demand, which directly is correlated with sort of unlocking UX, or kind of making more easily accessible, more efficient, right? So more efficient, more effective markets, definitely part of that. And we're trying to solve that part of the equation. But I think it is really about what you mentioned, unlocking that demand. And I think maybe from like a very sort of product-centric view, maybe it is not a entirely new asset. Maybe it is sort of tokenized T-bills. If I can sort of directly on-ramp from my bank account into a stable, then kind of purchase these things, hold them, custody them, and then sort of also sell them again. I think that's a really unique UX that doesn't really exist today, at least for someone that lives in Germany and has a German bank account. So something like that wrapped in a really seamless UX and product, I think that's definitely going to drive the catalyst, not sort of like the macro.
Right.
When I talk to people, so investors putting money into DeFi or into real world assets, they always say, well, like, what can you sell me that I can't buy anywhere else? And I think there's this may be one of the reasons why we started with private credit, because private credit is extremely illiquid, very fragmented market. Sometimes it's a couple $100 million asset classes or securitization. Sometimes it's bigger, but it's really a very archaic market, I would say. And then the other thing is, right, the other question or kind of need that people have is to give them something they can't do with these assets, and that ultimately all boils down to liquidity. And I think both of these are interesting. I think the 10x improvement is going to be when you can actually do something new with these assets, right? Because we can shave off basis points, we can improve the UX, we can maybe make better reporting, more transparent portfolios, and all of this. If you have all that and you make it a little bit easier, that's great. But if I can buy a product, if I can buy an asset today and I can sell it tomorrow, that's 100 times more valuable than if I have to buy it today and I don't know what to do with it.
Right.
And that will just impact the pricing for all these assets, right, like how expensive it is to borrow, how they're priced in general, how transparent this more up to date this pricing is, and like I think the place where like real world assets is going, like we have started with issuance, with process optimization, with like maybe some of the like portfolio construction on chain, but like I think we're getting to a point where we're starting to talk about this, which is I guess why we're here on this panel today. So so that we can then go and say, okay, now like we want to start trading these, and there's the chicken egg problem. It's the $1 million question: which real world asset is going to have first, secondary liquidity ever, or in masses, and how is that market going to look? But like that's I think what we have to work towards.
So on one of the earlier panels, there was a little bit of a divergence between focusing on the lower hanging fruit, the easier products first, right? So treasuries, money markets, dollar, right? Versus markets that are a lot more complicated with less liquidity, less transparency, bank debt, private credit, so forth. Where do you guys think, let's just say, the biggest bang for the buck is? And obviously there's some bias up here based on your products, but like where do you guys think the energy should be? Should it be in the simpler products and getting mass adoption, or should it be on the more complicated products that you can drive liquidity through, you can drive a lot more transparency and efficiency through? Chris, where are you guys looking? Are you looking at more of the complicated products or more of the simpler products when you think about return on your portfolio?
I think for us right now, what makes sense is the simpler products,
right?
Because we're regulated and we want people to be the first. We don't necessarily want to be the first movers,
right?
When it comes to trading something new or offering a new product, or being involved with something that regulators aren't comfortable with. Yeah, I think
makes sense.
We're on that end of things.
Yeah, definitely. We're as well. Right, we're a marketplace end of the day. So when we look at listing a specific asset, we look for what's the demand side of that. And the simplest stuff is definitely something that, again, from a product UX perspective, feels like more accessible and likely will be more accessible even more so in the future, in the more near-term future, than some of the more complex things.
Cool. You're grinning.
No, I'm grinning because I'm thinking about the last couple of years of like the only reason we're talking about simple products today in treasuries is because DeFi yield is below treasury yield. I think otherwise no one would have any interest in on-chain treasuries. Like that's maybe some stable coins out of diversification reasons would want to still hold treasuries on their balance sheet. But if you can make 6% on Aave depositing USDC and you can make 5% in treasuries, or maybe the numbers are even different. Like it used to be you can make 7 or 8% depositing USDC, and treasuries were yielding 0.5% or 0. That is like that is the world we were in, and that's why we started with very complex products, because we had to somehow find a way that we could actually offer something on top of treasury yield, right? Because why would you do it in the first place? Otherwise you just go and use Aave and deposit stablecoins there. Now, of course, the world is different today, and it is actually, and it does, so contradicting myself, it does make a lot of sense to start with the simplest products, because everyone does need treasury exposure. And maybe like back then, there weren't that many people that cared about having like safe assets on chain. I think that's changing. I think a lot of people actually got more comfortable with holding assets on chain. So they're like, actually, if I have stable coins, that's like almost better than having dollars in my bank account. So like, is this changing? I would have said like 4 years ago, private credit. Today, probably not just private credit, also the whole spectrum.
Okay, that's fair. Times change, right? So I do want to leave time for questions, because I feel like there hasn't been a panel yet that's been able to get questions in, and this is a great one for it. One last question. It's a little bit of a fun one, and don't put too much thought to it. Just say the first thing at the top of your head. What's the one thing that no one's talking about as far as being tokenized that you guys are the most excited about? TikTok. Whoever's got the first answer, go first.
I don't know if this is if this is not talked about. But I found tokenized income and lending against that. I find that to be interesting, just because of the specific in Europe we have open banking, so the prospect of getting a lot of that information in real time, then informing these decisions could be interesting. I don't know if anyone is doing that. I think Huma may be doing that. But that's one thing that I found to be fairly interesting. Again, this is entirely more a personal opinion.
Yeah, that's what I asked. You got it. Lucas?
I'm trying to not think too much about what we're doing every day and come up with something else.
It's hard
But
when you live it
I'm
every
totally
day.
blanking. I think, I mean, there's a whole bunch of very like tech first kind of fintechs that are going to bring like asset classes into like DeFi that we can't even think of, that don't exist in TradFi, and those are super interesting. Whether that's like tokenizing royalties and kind of doing revenue sharing on them, or whether that's I don't know, like, I mean, we did some stuff with gig economy lending, which I think is super interesting, because like the access to capital for an Uber driver is very different than someone that has a regular paycheck, right? Like maybe by now, like banks will give an Uber driver a mortgage, but like at least 5 years ago, that was impossible, right? And I think that is like the cool stuff that we'll see where actually we're making a huge difference.
That's good. That's good. Chris?
I can give one interesting one and one maybe less interesting.
Go for it.
I'm really excited about the tokenization of like IP rights and how you can segment down intellectual property and create a marketplace for intellectual property that can scale to like UGC gaming and merchandise. And I think there are like infinite applications there. On the less interesting side, in a prior life, I spent time brokeraging like secondary transactions, helping employees get out of like their shares in early stage private companies because they needed cash for a wedding or to buy a home. And I think that is a market that exists, but oftentimes like investors will come in and pay like a predatory price, and brokers will charge 5%, and these employees are kind of left paying way more than they otherwise would if there was an efficient, more liquid marketplace. And so I think that's like a really good application that can kind of spiral into a lot of different use cases.
Cool. Do we have any questions in the audience? Anyone want to be brave? Go ahead.
Quick question about where you guys think the U.S. plays in the future of the RWA market. I mean, we're sitting here in Brooklyn. People are coming to New York for conferences or to the U.S., but how critical is the U.S. market to sort of drive future growth of this segment?
Yeah. Well.
And I know there's a lot of your projects are for non-U.S.
So the U.S. is still the market with the most know-how in finance. Like, I mean, I think it's quite obvious, right? They pretty much dominate finance today. Maybe one of the reasons why we are in New York is, well, like, where else do you find people that actually know about this stuff? Now, in many other places, I think in the midterm, maybe short to midterm, like, I don't think the U.S. is a market where it's going to be easy to innovate. Although I have to say, like not for secondary markets, but for like some of all of the issuances we started with were like Reg S, Reg D offerings of the Delaware company. So like actually for that it worked quite well. Now in the current climate with all of the stuff that's happening, like yeah, it will probably take some time. I think sooner or later that there will be some movement, hopefully as favorable for DeFi as possible. I doubt that the U.S. will just completely outlaw it. I think by now, hopefully, we've crossed the point where you can brush crypto away, you can brush this technology away. I think banks, regulators, politicians, they've all kind of realized that. Now, I think when there is regulation that does sort of make some of these things easier, right? Like that's when you will actually start really doing trading stuff, right? And so I think it's a matter of time. But yeah, like who knows?
You have any thoughts, Phil?
I mean, operating an exchange and marketplace, as you said, we're ring fencing the U.S. We have to, and arguably, we want to engage. We want to have a constructive dialogue with regulators also in the U.S. That's something that we're interested in, that we want to pursue, that we are pursuing. But for the time being, and also in terms of giving the stage of or venture, the timing to find product market fit and so forth, it's not something that we're hopeful for the near term.
Chris, any thoughts?
I think we're in interesting seats because like regulatory arbitrage is finally a massive part of the industry, and I think we've shown time and time again that people are willing to move around depending on where they need to be to find product market fit and to work with regulators that are willing to work with them. But like from our shoes, we work closely with regulators across the world where all of our offices are, and I think it's a waiting game.
Everyone's being very polite today. So, any other questions? You can stand up. It's a pretty small room.
Hi, Jason Gracino with Plural Energy. So we're talking about secondary liquidity, and we haven't talked much about market makers or market making. So I was wondering how you all view market makers' place with secondary liquidity, and how do we incentivize market makers without going down some other less favorable paths like payment for order flow?
That's a great question. As one of the market makers, you want to talk about?
Happy to take that one. I think like as a market making firm, we can really make markets in any product that has substantial liquidity. In the crypto space specifically, a lot of the markets that exist today exist because of market makers, because there is liquidity there that retail can interact with. And unfortunately, like for the products that don't have as much liquidity, I think there have been like incentive programs and companies essentially have to like pay for the infrastructure that is market making. But as more and more people pile into the space, as liquidity becomes more and more natural, we have like softer flow. I think it becomes easier to interact with. Like we already have the infrastructure to scale as people enter the space. It's just really like product dependent and flow dependent.
Yeah, I mean, the reality is, and I can speak to this a little bit because Chris and I work together at Tower. The reality is that, the digital markets are built for market makers, right? It's very easy to trade. The one piece that has been missing is the liquidity depth in the market. And the reality is that liquidity was created by most of the market, the traditional futures and equities market makers, and they, for various reasons, have left the market. And so that's why you've seen the liquidity dry up so much. And so I think the key, some of it's regulatory driven, and there's plenty of news out there on that. I think also, most of those players are volatility players, and the volatility has gone. So the arbitrage is not as attractive to a lot of them. And Chris can speak to this as well. Like they're very opportunistic, and they're going to find where the largest return on a capital is, right? And if it's not in crypto, they're going to go back to equities and futures, or they're going to go to bonds or wherever. So I think volatility is key. It drives markets. It brings market makers back, and it creates revenue for them. And that has just been non-existent in crypto for the last year or so. So I think that's, it's a good and a bad thing. Nobody loves high volatility, but it does create a lot more liquidity because it pulls those guys back in. So I don't know if you guys have any other thoughts on that, or no? No? Okay. Any other, are we good? I think we're being called. Oh, we got one. Can we take one more? Can we take it in the hall? Yeah, absolutely. We're getting the hook. Appreciate it.
Thank you.
Thanks, guys.